What is going on, guys? Bexio back, and today we got a brand new video. This time with the stock market crashing for the second time. We thought Apple did just enough to bail us out, and then Facebook came along and undid all of that with their absolutely terrible earnings. Now we see the market in another very tough spot. But before we get into that, if you are not subscribed, make sure to smash that sub button because we are on the road to 1,000 subscribers. But let's just take a look at the market and how absolutely devastating it really is. You can see on that left side here, everything red across the board with a very select few. We have the market volatility is green, Alibaba somehow green, and Robinhood somehow green as well. So a couple of greens, but those are literally it on this list here. So all of tech, Apple's down, we got Plug down, we got Tesla down, even Microsoft, which a lot of people were very excited about, is down as well, almost 3%. So these individual stocks doing not so great. And if we just look at, the S&P 500 as a whole, again, another gap down here. So a couple of things going on. The Facebook earnings dragged the entire indices down. They were very bad, very, very bad. And that was basically it right now. So now people are scared of earnings again. That was what we had before. A lot of fear around earnings. And then now we had Apple and Microsoft. Microsoft was all right. Google was all right. And Apple was really good. And we thought that the market could have gotten bailed out. But Facebook came in just in time to drag the entire market back down with it. But this is the time to look at the historical data for investing and why you don't want to be extremely fearful even when this stuff's happening and make decisions based only on being scared or fearful. So here it is. A few poorly timed trades can torpedo 2 decades of healthy returns. So this is the biggest problem with trying to time the market, one, and thinking that timing it is going to be the greatest thing for you. So the problem with timing the market too, before we look into all this data here, is that you have to be right twice. You have to be right when you buy and right when you sell, as opposed to long-term investing where you only have to be right once, where you think the company is going to do better in the future. That's what you got to be right about. And that's what a lot of people go into think they can time the market, trade the market, and then end up falling into what the data shows us right here, which is since 2014. So 8 years almost. And if you just look at this chart, it just says if you look at like this top here, it says 65,000. If you had $10,000 invested between January 3rd, 1995 and December 31st, 2014. So basically 20 years, almost 20 years. And you can see this top here, 65K would be what you would have at an average yearly return of 9.85%. But you can see how drastically it falls off a cliff if you just miss the 10 best trading days, just the 10 top trading days over a 20-year period. So if we just do this, we know 365 in a year over 20 years, so 7,300 days. If you missed 10 of those 10 days within this period, then you would have, that is only 0.1%. If you missed 0.1% of the best trading days, your return plummets from 65,000 to 32,000 with only a 6.1% yearly return. If you go on even further than that and miss the 20 best days, you drop further to 20K. The 30 best days, you drop even more to 13,000. And then if you miss 40 days within a 7,300 day period, you actually lose money. So all it takes is missing 50 days or missing 40 days here over a 7,300 day period, which is 0.5%. Half of a percent is all it takes over 20 years for you to lose money trying to time the market. And it just keeps getting worse and worse from there, where you lose money after missing just half a percent of all days in 20 years. That is just crazy to even think about that that's even possible. And what you see right here in the middle here is 6 of the 10 best days occurred within 2 weeks of the 10 worst days. So what that means is when the market is in states where it is right now, where it's very bad, very red, downtrends, usually the best days come after the worst. So when we're in a market like this where we're seeing red on red and continue moves down, that's not the time to sell. Historically, that is actually the time to keep buying and thinking longer term. And those best trading days of, the decade come after those worst trading days. So we saw it in 2020 with the pandemic crash there, and after that crash, some of the best trading days came after that fall down. So could we be seeing something similar now, where we're seeing the trading days getting real bad right now, but within 2 weeks, are we going to see this massive rebound and this massive great trading where, we start getting 10% gains, 2% gains a day, 5% gains? We start seeing the market rally, and that would be more often than not what actually ends up happening. And to show that the bubble might be popping, we have Warren Buffett beating out Cathie Wood's ARK fund, ARK Innovation. So Berkshire Hathaway is outperforming ARK Innovation right now, which is kind of crazy because we know he didn't get involved in like all the speculation. He sold airlines. People were against that. Airlines rallied for a bit, but we're seeing the long run Warren Buffett strategy actually coming out on top here. So their price return compared to the S&P 500. So Berkshire Hathaway is this orange line, actually outperforming the S&P only since about November, so it doesn't go back, terribly far. But you see even ARK plummeting, doesn't even come close. You compare it to this is their other fund, the Berkshire B. I don't know what the biggest difference is between those funds, but then you throw in Coinbase, Roku, Teladoc, and Zoom. And you can see all of these are big Cathie Wood's companies, the big ones that she likes. She's big in Coinbase, big in Roku, I think at some point. I don't know if she still is. Teladoc was a huge one, and Zoom was a massive one. You can see every single one of them are lower than just the S&P 500. Not a great thing to have. It is a short time period, so we'll see what happens longer term. But right now, it does look like Cathie Wood's isn't doing too well when you're severely outperformed by just the S&P 500. So we got Cathie Wood's getting outperformed by Warren Buffett. Her stocks getting outperformed by the S&P 500 index. And we got, timing the market, not necessarily the best thing to happen. And the best days could be happening very soon if history is something to go off of, where the best trading days come after some of the worst. So we'll be looking for that, see how it all plays out. But you don't want to not be in the market and miss those best trading days, because then your return gets drastically cut down and you start losing way more money. And it only takes 0.5% of a miss on 20-year period to actually lose money. Those stats are absolutely wild. That is such a low margin of error that can actually cost you all of your return. But that's going to do it for this video, guys. As always, remember to smash the like button and subscribe. We're on the road to 1,000 subscribers. I'll see you guys in my next video.